This is Sing Enterprises. First thing we do is have a read of the question. It's not a bad idea to start with the required to see what kind of a question we're being asked. So it says show the relevant income extracts and statement of financial position extracts for the years 2011, 12 and 13. Okay, so it wants extracts. Sing Enterprises started business January 2011, reporting period end of year, uses straight line depreciation. Okay, 1st January 2011, purchased a machine for 10,000, expected useful life 4 years, residual value 2,000. 2012, purchased another machine 15,000. Okay, right, so those are the details. First thing to do is just to write out in free form before we show the extracts what the position is, something that's clear to you. And often it's the case that you use time across the top and whatever you want down in the columns. So in this case, let's start with machine 1. As with all these questions, you take it bit by bit. Machine 1 seems reasonably straightforward apart from the disposal. So we purchased it for 10,000. I put a blank up here because in this case it's the beginning of 2011. So 10,000, and we have to calculate depreciation. I've done it like this. 10,000, 2,000 residual value over 4 years means a 2,000 depreciation per year. So we put 2,000 for each of those years, and that gives us our net book value. And well, we will I've got net book value down here, but we might also put it up here. Doesn't matter, these are just rough notes. So 6,000, so 10,000 down to 8,000, down to 6,000, down to 4,000. And on the 31st of December 2013, the business sold the first machine, so we've got a full year's depreciation before we dispose of the machine, and that means we're going to write off the asset of £4,000, and it was sold for £3,000. So we write off that for 4,000, and we get some sort of return. We don't quite know if it's cash or debtors of 3,000. So clearly you've made something of a loss because the cost was written down to 4,000, and so you have a cost of sale here. And then I've made some notes down here on the loss on sale of asset. So you've got the cost of sale there and cash here, and then you have, so that on the asset side of the equation you can see is a net negative of 1,000, and on the profit side that's a loss of 1,000. So our equation balances as minus 1,000 on both sides. Note that I've condensed sales minus expenses as profit, or if it's negative obviously it's a loss. Note that the 6,000 provision made over these 3 years is going to be written off against the £10,000 cost of the machine, right? So this is on the what we call the credit side. The right hand side is going to be, it's a provision, and it's going to be set off against this cost. So when we say net book value, that's the remaining value that we've got to write off that we've not provided for via depreciation. So that accounts for the loss. Now let's move on to machine 2. Machine 2, where is it? It's 15,000. Yes, bought another machine for 15,000 on the 1st of January 2012, so that's the whole of the year. 15,000 there. Has a useful life of 5 years, expected residual value of 2,500. So the cost minus the residual value is the measure of the amount we've got to write off over 5 years, 2,500 a year. So we proceed in much the same way as for machine 1, 15,000 only in 2012, 2,500 depreciation in that year, 2,500 depreciation in that year. So right, so those are our notes. Now we need to progress to writing up our answer. So we start with 2011, and here we have the machinery purchased at the beginning, 2,000 depreciation, and the income statement is going to be a reduction in our profits of 2,000. It's a provision. We're reducing our profits by 2,000, setting it aside, taking it away from the hands of the equity holders and saying, no, we must set this aside to provide for the loss of sale of the machine. So that is the extract we've taken. Now the question isn't completely clear, because obviously you might be thinking, well, was this machine purchased on cash or credit? Shouldn't we be putting that entry in as well? And the answer is yes, if we knew. And it should be more specific as to exactly which entries it wants. So it's not entirely clear. We do try to rule out any such ambiguities in any assessment, and so hopefully that won't happen. But if you do feel there is an ambiguity, then write it out in your notes down here, which I've not done, but perhaps I should have done. Okay, so 2012, we've got an additional amount of machinery of 15,000, and we've got an additional depreciation of 2,500. Right, so we've got our balance sheet is going to show the total amount of depreciation set aside. 2,000 in the first year, and in the second year, 2012, we add the 2,500 and the 2,000 there. So it's our total provision, right? It's our total depreciation provision. So that comes to an extra 4,500 on top of the 2,000, 6,500. And that extra is charged to the profit and loss account, the income statement. So that is going to be the additional amount. Okay, so remember the income statement represents the movement over the year, and the balance sheet is kind of the position statement where we've got to on this year and including previous years if relevant. So now the sale was on the 31st of December 2013. So at that moment our total machinery is going to be the 25,000 but less the 4,000 written off, so 21,000 there. Okay, so sorry, it shouldn't be that. We've got to look at it. What have we got at the end of 2013? We have our machine 2 at 15,000, and we have the depreciation on machine 2. We've got rid of machine 1. So we've got rid of the 10,000. We've got rid of the 6,000 that was in there as the depreciation, accumulated depreciation. So we've got rid of all those, and then also we have made a loss on the sale, which is not going to appear here because this is just about what machinery we have and what provision we've got against that machinery. So 2013, the position is actually reasonably clear. We've got 15,000, we've got two lots of 2,500 in there, and our net book value is going to be 10,000. On the income statement, we do have a full year's depreciation for both machines there, so that's the 4,500. And then we have the loss on the sale of the asset, which, as we've explained down here, we've got our cost of sale. That's the remaining 4,000 that we weren't able to write off. We had 10,000 cost, we had 6,000 provision, we had 4,000 left over, so we've had to write that off, take it out of assets, and in return we only got £3,000 cash, and therefore our asset value has reduced by 1,000, and that's reflected in our profit being lower by 1,000. So in writing all that off, we have also increased our unnamed asset by 3,000 and our loss of 1,000. So the net effect on assets is minus 1,000 and on profit is also minus 1,000. So we've kept our double entry there, but you'll appreciate that some of the other side of the entries, the cash entry for sales or whatever it was, debtors, has not been entered, and the answer just gives this as the extract, and as I say, that is a little bit ambiguous. So hopefully a clearer question that would simply say that it wanted the entries for the fixed asset account giving net book value, and the income statement extract of the depreciation charge and any profit or loss on sale of the asset. That would have been clearer, and hopefully if you are being assessed, that would be the wording of the question. Okay, thank you.